Okay, great. Thanks for having me here. And it's been a real pleasure to read this paper. Whoops, I'm not sure I can change. Oh, there we go. So what this paper does is investigate optimal monetary policy and foreign exchange market intervention for a small open economy. Just to give you the background, the setting is one with a sticky non-traded goods price, flexible traded goods price, nominal bonds are traded, and then there's an arbitrageur that has to intermediate the trade in these bonds. There are noise traders that create exchange rate shocks. And then foreign exchange market intervention is going to allow the government to trade home bonds for foreign bonds directly. And monetary policy is going to set the wage directly. And so the outline of my comments, I'm going to summarize some of the main results. By the way, I say I only got the first 15 pages, but I think that's all they've done so far. But there's more to come, I think. Then I'm going to talk about the intermediaries objective. I'm going to discuss some alternatives. I'm going to talk about exchange rate volatility per se, some of the costs of stabilizing exchange rates, and then some conclusions and suggestions for future work. So let me just I can't go into all the richness even of this first 15 pages. There's a lot of stuff going on, but I'm going to focus on a few things. So in this model, the optimal real exchange rate should equal this. And AT is productivity in the non-traded sector. CT is consumption of traded goods. This is what the real exchange rate actually is. And you can see then that one of the things you're going to want to try to do is make the nominal wage equal to the productivity in the non-traded sector. The other thing they say you would optimally like to do is have this risk-adjusted UIP condition hold. But because of this intermediation distortion, there's this other term here. You want that to go to zero. And one thing is that this term is increasing in exchange rate volatility. Okay, so what are the optimal policies? Well, if you have both monetary policy and foreign exchange intervention available, you use the monetary policy to set the nominal wage equal to this non-traded productivity, or you can think about it as it's setting the exchange rate according to this formula. It's got to equal the real exchange rate to the 1 minus gamma power times the output gap. And then there's this foreign exchange intervention. And what the foreign exchange intervention does is just take over for the intermediary. Instead of having this constrained intermediary, the government comes in and does all the bond trading. Now, for me, realistically, this is not actually a policy that's going to be easy to implement because, the foreign exchange intervention here is not aiming to stabilize the exchange rate. The exchange rate is being, it's monetary policy that's aiming at the exchange rate. The so-called foreign exchange intervention is taking over the role of intermediaries, and they have to be, the central bank would have to be really on the ball to be able to do that. They'd have to set up their own little bank, I think, and figure out how to do that. But to me, one of the interesting things is that when the optimal real exchange rate is pretty stable, then you want to use monetary policy to just stabilize the exchange rate. You don't need to worry about the real exchange rate fluctuations, and stabilizing the nominal exchange rate then is one way to get rid of this deviation from UIP. So if the real exchange rate didn't have to move very much, you would use monetary policy to stabilize the nominal exchange rate. Let me just say one quick thing about the objective of the policymaker. I mean, there is still incomplete markets in this model. So the way this is set up, it's like, well, the policymaker wants to do what the market would do if there were none of these intermediary constraints. But I think the policymaker might want to do better because there's a possibility of getting even more risk sharing given the lack of assets that are traded. But I want to actually focus on this assumption about the intermediaries. Now, suppose that the intermediaries here are owned by home households. Suppose their objective was just to maximize the utility of the owners. This would be their objective. So this is the amount of foreign bonds they would hold. This beta CT over CT plus 1 is their stochastic discount factor. They have log utility. People have log utility, and then this is the excess return on Chilean relative to American bonds. You can rewrite this in this way, and I'm writing it this way to emphasize that in this case, the intermediary is already risk averse. I mean, if they're concerned about using the household stochastic discount factor to evaluate profits. They're already incorporating the risk aversion of households. They've got the systematic risk that they care about, the risk of the excess returns and how it covariates with the stochastic discount factor. What's odd is that to that term, which already contains systematic risk, they append another term for the intermediary where they care for some reason about unsystematic volatility in the exchange rate. And so that's the thing that I think needs more micro foundations, because I don't quite get it. Why do they, I mean, I don't know. I mean, it's to some extent, it seems plausible to me that the intermediary has a special aversion to nominal exchange rate volatility beyond systematic risk from exchange rate fluctuations. But why? Why is it that they care about this unsystematic risk? And is it because there are some balance sheet constraints? That would be one model, or maybe there's a cost of buying exchange rate hedges. Maybe it has something to do with liquidity, like in my paper with Bianchi and Biggio. But then if we know kind of the true reason why this uncorrelated exchange rate risk matters, then I think it might be that there's a different policy that's optimal, or maybe a simpler policy, something about some kind of banking regulation or something. So it would be worthwhile kind of exploring that in greater detail. What is it about this unsystematic risk that is so important? More generally, it makes sense to me that its limits to intermediation are going to get in the way of perfect risk sharing, but it would be nice to have more empirical evidence on that. Is the volume of international borrowing and lending affecting the degree of consumption risk sharing, and does that depend on the degree of financial development? Actually, something that the governor of the central bank said in his introductory remarks was interesting about how Chile has had more domestic financial development, but has that increased risk sharing? And actually, I'm just a skeptical guy about financial institutions. I wonder if even within a country, more financial development actually improves risk sharing. Beyond that, do the size and volatility of deviations from UIP depend on the degree of financial development? So it'd be nice to have empirical evidence on that. For this paper, what's really important is the exchange rate volatility per se what lies behind the financial institutions not providing as much risk sharing as would be desirable. So there would be great if there were more empirical evidence that said, look, these financial institutions, if there were only less exchange rate volatility, they would be doing more intermediation. Okay, let me just make a general point about exchange rate volatility distortions in relative prices. And this is a little bit off the topic of the paper, except it's in there. I mean, in general, even without noise traders, there's a problem when you've got exchange rate volatility. You want the exchange rate, as in, in this paper, you want it to kind of do the job of delivering the relative price of traded to non-traded goods that's desirable. But there's all sorts of ways in which exchange rate movements are getting in the way. For example, even in this kind of divine coincidence type of model, where everyone's following the exchange, the right policy, if there's uncertainty about what's going to happen in the future, and there's news about the future, but if there's uncertainty about what the policy is going to be in the future, and then you get news about the future, you'll have exchange rate shocks that are distortionary even under the supposed divine coincidence policy. But for sure, even in a richer model, there are all sorts of things that I think actually are realistically leading exchange rate movements not to be delivering anything like what we want. They're not delivering the real exchange rate movements that are efficient. So, for example, a model with risk premium shocks, or with dominant currency pricing or local currency pricing, nominal exchange rate movements are just leading to inefficient relative price changes. Okay, so my point is that even without noise traders, there's some kind of inefficiency there, and you might want to think about what the nominal exchange rate is doing. I think that's kind of well known, but I said it anyway. All right, so to summarize my comments so far, one of the things I'm worried about is what is this risk sharing distortion? Is exchange rate volatility the reason for it? But now I've argued that, well, there's a case for stabilizing exchange rates, but should we do that? And I think there are reasons to be cautious. So now I'm definitely stepping outside the model, but the model, is set up so there are no actual costs to inflation. There are no Calvo price settings, so there are no relative price distortions from exchange rate movements. There's no, Rottenberg costs of adjusting prices. And moreover, the optimal policy, if you've got both instruments, is time consistent. But in the real world, credibility or commitment really does matter a lot. And, I think that inflation targeting, which a lot of emerging markets have adopted in the last couple of decades, has gone a long way to, increasing the credibility of monetary policy. And without it, I think there's a real inflation bias. So this paper kind of has the flavor of, okay, now we've established credibility for monetary policy. Let's forget inflation targeting. Let's go after these other targets. And I'm a little bit worried about that because, when we've had policies in emerging markets that target exchange rates, then we've had these, we've had these episodes of overvaluation and catastrophic devaluations. There was original sin, so governments couldn't borrow in their own currency. And those things have really been greatly ameliorated with the adoption of inflation targeting. And I think that's because it gave credibility to the monetary policy. And in fact, kind of in general, this idea that we have to target more things, I mean, that comes out of our models, but I'm worried about what that means for monetary policy credibility. I mean, right now, in the US, by law, you have to target inflation in the output gap, but there's all this other stuff. Oh, maybe we should target the exchange rate. Or the Fed is thinking about, maybe we should target income distribution now. And the ECB now claims it has a mandate to target climate change. But the more things you target, I feel like the less credible your commitment is to monetary policy. It's difficult to convince the public that you're following kind of, as Svensson calls it, a flexible targeting rule. If you're saying, I'm targeting like 8 different things, and just trust me, I'm committed to this policy. I'm just targeting a bunch of stuff. So I think that, my sense is, especially with emerging markets, it might be a little too soon to abandon inflation targeting or with a little bit of flexibility in there, because it's worked well in the last couple of decades. And so I'm nervous about that. So, just to conclude, I think it's a nice paper. It's got a lot of neat insights. One thing that the paper does bring out, which is in other papers, but I think this paper really highlights it, is that this asset market segmentation, whether it be because of this aversion to idiosyncratic foreign exchange risk or for some other reason, it introduces a distortion, but it also breaks the trilemma, and that gives a reason why foreign exchange market intervention would work. And so that with central bank, there's another distortion, but there's also another policy tool. But the question again here is empirically, does foreign exchange, does sterilized intervention work? Is it effective? And I think the kind of the empirical evidence is, not that strong. I mean, sometimes it works, maybe, but that's not totally clear. So actually, I think the paper raises a lot of really interesting questions. It's got a lot of real insights. And so it succeeds in that way, but it also succeeds in suggesting interesting future work. Thanks.
Thanks to you, Charles. Now we have some questions, but probably you, Oleg, want to say something else before the questions?
Let me try to just quickly respond and take as many questions as I can afterwards. So thanks a lot, Charles. I mean, this is fantastic. We thought about a few of these things, but obviously you gave us, many additional directions. I fully agree on the exciting empirical work to be done with this. It's just we have not even nearly gotten there. We're still exploring the theoretical results. And so I wanted to advertise that I actually posted today this 15 pages that you mentioned on the website. And the goal of those 15 pages was to outline the simplest analytical results that come out of this framework. And so what we're working on now is actually getting into interesting cases. As you can imagine, the simple analytical results, they sort of characterize the limiting cases. And you can learn quite a lot from limiting cases oftentimes, but the truly kind of realistic area for policy trade-offs is perhaps somewhere away from these limiting cases. And you bring up a lot of sort of reasons that could be put into a model and then evaluated. But then, you know, it wouldn't be anymore at the corners that are simple. It would be somewhere where you need to evaluate things quantitatively. In particular, a lot of the time, we kind of either characterize full commitment or no commitment at all. You know, and with full commitment, you obviously can do a lot more. With no commitment at all, oftentimes it just unravels and you can only do, for example, just output gap stabilization and not address UIP deviations at all if you didn't have commitment. And so you kind of, a lot of your points were emphasizing the specific storylines that you can tell and pursue in detail kind of to evaluate those things. What I was going to say next is, well, one important thing is divine coincidence is much more robust than the simple tradable, non-tradable model that we wrote. It extrapolates to environments with PCP, DCP, home bias. You just need to define the relevant real exchange rate in the right way. It will be not the first best then, but under DCP, for example, it will be the constraint efficient real exchange rate, because there are some inefficiencies that the government cannot deal with under DCP, but there is still a constraint efficient real exchange rate. And in that sense, divine coincidence result is useful because it's quite robust to the goods market friction. You mentioned a great point that yes, like the you know, the government might try to do better in terms of risk sharing. You know, that's why, you know, you can call it first best or constraint optimum what the government does here. But what's interesting, in the absence of this international transfers, right, the government cannot do better than this risk sharing. When there are these international transfers, when part of the incomes in the financial market stay at home and part go away, then you can try to kind of work with it and try to complete the market, right? But it turns out that generating monopoly rents is a more interesting goal for the government under those circumstances that creating risk sharing. But it's a very interesting sort of direction to go. And so we plan to explore that. One big point that I really want to make before I stop here is, yes, so you asked us about the friction, right? And this is one big commitment that we make in the paper, is that a particular friction, and it's microfounded. And the microfounded friction is the interaction between segmented markets, which is kind of essential here, and risk-averse arbitrageurs. And what we mean by risk-averse arbitrageurs here, it's that they have to hold exchange rate risk. They don't have the means of offloading that risk to somebody else. In that sense, they're not evaluating the risk using the SDF of the households. They're really evaluating the risk that they hold and cannot diversify, because it's hard, like, you know, they need to intermediate those trades, and at least temporarily they have to hold the exchange rate risk. And that's why the SDF of the arbitrageurs is much closer to the returns on the UIP trades. That's why they care about them so much. If we went the route that you propose, you're just not going to generate quantitatively sizable UIP deviations in equilibrium if you evaluated them using the household SDF, because as you said, it's only the correlated part of exchange rate risk that matters, and it's small. Right. And so this is the reason why in the previous paper with Dima, we had to argue that it's got to be segmented market with risk-averse arbitrageurs. That's really the micro foundation. Now, I believe that there are other frictions in financial markets as well. It's just to capture the Musa puzzle type of evidence. You really need to emphasize this one. And it's exactly this friction that directs our analysis, right? But I mean, I think it's very exciting to change the friction to financial constraints or liquidity constraints and see whether analysis generalizes. I imagine it's complementary analysis when you do that. Yeah, let me stop here and take more questions.
Thank you, Oleg. Now, Pierre Olivier, want to make you a question?
Yes, can you hear me?
Yep.
Okay, so very interesting paper, very related to some of the other papers presented today, so very exciting. One thing that Charles mentioned, I think, is really critical is effectively the government here can bypass the intermediary, can substitute for the intermediaries. Now in what sense, there must be some sort of deviation from Ricardian equivalence here. Somehow your household won't own the government, otherwise they would indirectly understand that they can bypass the intermediaries in the first place, and somehow all of this would aggregate. So there must be some sort of some sort of assumption underlying this. And more generally, I guess the question is, you know, when we think about the government stepping in and sort of bypassing a financial friction like this, the U.S. government borrows at 0% effectively. Why isn't the U.S. government borrowing at 0% and then lending to the private sector? It sounds like a good idea when you look at it this way. We know it's not a good idea. We know that, of course, the risk would be reflected on balance sheet of the government. The risk could be taking, and then that would be sort of the risk that the households indirectly would be also bearing. So you can't do that. I wonder if in your setup this shows up in some sort of longer distribution of the foreign reserve holdings that they would need to have, that somehow there is some sort of with all probability, almost surely, whether the government would become bankrupt or run out of reserves, something like that would happen in a setup like this. Anyway, I thought this was very stimulating.
This is great, yeah. And so this is one comment of Charles that I didn't address, but going back to Charles' comment, he said that the government effectively replaces the financial sector here. And the answer is yes. And perhaps that's why such large FX interventions are unrealistic, that the government will do them in a more limited way. And going back to the second part of Pierre Olivier's question, well, we can derive exactly conditions on, say, volatility of the government balance sheet or on the returns on that balance sheet. And so if you think that there is limits on the size of the balance sheet, on volatility of the gross positions, or on possibly negative returns, like value at risk type of, you impose any of that constraint, you can do a constraint problem, and then you'll see that the government will go only part of the way in stabilizing UIP until it reaches that constraint, right? And that's much more realistic. That's what we plan to explore in a quantitative framework, departing from this limit in case, exact results. And so that's exactly why we see so much exchange rate volatility, perhaps, is that there are limits on the balance sheet of the central bank. Like think of Switzerland in 2014, 2015. This is the reason why you don't want to peg, perhaps, and eliminate UIP deviations entirely. It just could be too costly from the second moments of your balance sheet, right? Even though it's not costly in terms of expectations, right? You don't make or lose money on this in principle, but the size of the positions can get really large, and sort of the edges, the left tails and right tails of returns can get really large. So now, what's the nature of it's a chicken problem, obviously. As you point out in the beginning of your comment, households are segmented. They can trade foreign currency bonds. In that sense, it's not a model of the US. It's more a model of, either developing countries or smaller developed countries, like, I don't know, perhaps New Zealand, or, it could be the UK as well, right? And so the point is that the households can really borrow only in the domestic financial market. And what the government has, it can hold positions in both home currency and foreign currency assets. And this is what breaks the Ricardian equivalence between the household and the government. And this is kind of, the segmentation is the crucial assumption. It's very crude, but it's very difficult to find something in between full segmentation, like we oftentimes work, and an integrated market. But we know once you write an integrated market, as Charles pointed out, you have the trilemma back. You don't have sterilized interventions being very effective because the household will just undo it, right? And you unfortunately have to choose between this fairly discrete set of models, and there is not much in the space between them. But perhaps that's where the theoretical literature should go, like partial participation or something like that. The last point I want to make: there are fascinating things about the data, and Charles partly and Pierre Olivier addressed it. Is like we have financial integration that happens, arguably both at the micro level, at the countrywide level. Why do we see so much UIP deviations and exchange rate volatility and equilibrium? So much risk premium in equilibrium. The more financial integration there is, this model suggests that somehow probably risk premium should go down, but we don't really see those. And so it's kind of interesting to understand why financial development did not undo many of these frictions, right? I think it's a fascinating question to which I don't have an answer. And the last thing, I think it's totally fascinating to think why, more generally, the government cannot use its looser borrowing constraint and help the households and firms that are at a tighter borrowing can say, what is the friction? But it's outside of our model. So here it's a different type of friction. But in principle, these are super interesting questions.
Thank you. Another question? I'm told that Septem want to make a question to Pierre Olivier. She couldn't do that in the past paper. Probably both of you have something to say. Are you here?
Yeah, okay. Can you hear me?
Yes, we can hear you. Please make your question.
Okay. Yeah, so actually now I have a question to Oleg, but I can also ask my question to Pierre Olivier. Actually, yeah, let me try to combine the questions. Although in the previous session, Helen had another question to Pierre Olivier. Maybe we can bring discussion back tomorrow. Okay, so I would like to take this whole to the what we know in the data and how policymakers can apply these things setting. We are in a policy conference at the end. I mean, super interesting presentations, both from Pierre Olivier and Oleg. But how you do these things in practice and what is in the data? What do we know? So, okay. So if we go back to Pierre Olivier's presentation, that seems to suggest there is a pecking order, right? So it is better to have flexible exchange rates and do the counter-cyclical policy based on this basis, CIP deviation. So that's very nice, right? So it tells us, don't touch the exchange rate. You know, you can do a counter-cyclical macro-prudential counter-cyclical capital flow management by looking at the basis. And then Oleg tells us, well, yes, maybe you don't want a pure peg, but you want some control on the exchange rate. So, I mean, they are talking about different frictions, but that's what is going to happen at the end, right? If you write down a model, if every model has a different friction, they are going to give a different answer, regardless of the micro foundation. So at this point, we need to go and get evidence on that micro foundation of that friction and also what works in practice in the policymakers arena. And that takes me back to Charles's comment. So I would like to suggest actually, exactly as Charles said to Oleg, right? I mean, if you think in terms of the credibility, then you probably don't want to target the exchange rates because that is something, you are going to lose credibility very quickly if you use monetary policy rate to target the exchange rate. And this goes back to Pierre Olivier, right? How do you do these things? Then Oleg said, well, they motivate by looking at the larger UIP deviations under peg versus float. I mean, that's not very informative to me because under peg, there's no UIP deviation. So if you look at a hard peg, I mean, what does it say? Not much. If you look at a managed float and a pure float, this flips, right? This is not linear. Actually, UIP deviation is going to be larger in under managed float than a pure float. So why that is? Because again, going back to this policy credibility point, and that links exactly to Pierre Olivier's suggestion, why don't we do this with this counter-cyclical policy? And emerging markets has that policy, right? They do something called, for example, reserve option mechanism. That's a counter-cyclical capital flow management tool on the domestic agent. That's another question. You do it on the domestic agent or on the foreign agent. So with another tool. So now when you look at these things in data, what is managed float, what is pure float, how that managed float is done? Is it done through monetary policy rate or reserves or, some sort of capital control tools? That makes a huge difference. And that's exactly going to go back and how you model the financial friction. So depending on how you model the financial friction, you are going to get different results. So in that sense, I would like to ask, both Pierre Olivier and Oleg, how do they see things? So say we don't touch the exchange rate. Okay, it's a flexible exchange rate, but we do want to somehow limit the UIP deviations and CIP deviations and volatility. Let's say we do it with counter-cyclical policy. So then how we do it? I mean, are we going to put on the domestic guys if they are doing the central bank, or we want to go back to the global lenders? I mean, this is why I started at the beginning of my presentation. There are two sides of this. I mean, you are going to regulate the lender somehow, or the borrower, or domestic lender, and this goes back to Charles' point, right? Are we going to do it through banking regulation? Which bank? I mean, if you do it through a central bank reserve, that's for domestic banks. If you do it with a tax, then it is on the JP Morgan. My final point here, so which goes back to, again, this stochastic discount factor business. I mean, I fully agree with Oleg that we want to think this role, there is a segmented market, some sort of financial friction, but then there is endogenous risk erosion. In fact, we do this in my new paper with Özge Akıncı and Albert Koeralto, where actually you don't have the CIP deviation. There is no wedge in the foreign bond Euler equation, but there is a huge UIP deviation because of a second moment risk premium shock and the stochastic discount factor over to JP Morgan. Because how does it work in the real world? I mean, okay, so you're a country like Turkey. There's huge increase in your UIP risk premium with the bad shock. JP Morgan doesn't go and makes the Turkish share in the portfolio zero. He will never do that. Why would he do that? I mean, there's a huge return from this, right? So JP Morgan adjusts the portfolio, and during that adjustment, there is a constraint. Yes, there is a leverage constraint on JP Morgan's funding. So if JP Morgan wants to be exposed to Turkey more, because there's a huge return from Turkey when the UIP premium increases, then JP Morgan needs to fund that. And that funding is going to be restricted. That's the leverage constraint. That's the regulatory constraint that we can bring in on global lenders, right? But that's very important, right? That's how we want to think this. So even there is no friction, I mean, the friction is going to come endogenously because of this risk premium shock. So in a sense, we want to think both. I fully agree with Oleg, but in a dynamic sense, right? With risk premium shock, this is going to change because, again, we don't live in a world where JP Morgans of the world don't make Turkish share in their portfolio zero when the UIP premium is going to the roof. So they adjust that, and that depends exactly on their funding conditions. That's why dollar liquidity matters. That's why, you know, things like value at risk, leverage constraint matters. So, but then we go and write down models only we have one of those things, right? So in that sense, but then we want to link it to policy. Then we want to say, okay, you know, you do countercyclical policy or FX intervention, but I mean, the way you say those things is going to be depend exactly how you microfund that friction. So I would like to, you know, ask how Oleg sees these things. Thank you.
I have just two quick remarks, and then I'll pass it on to Pierre Olivier. One remark, I mean, I wish we had dinner after this so we could discuss. There's just too much stuff to discuss here. Super interesting points. I think Charles actually did not say that you necessarily want to stick to inflation targeting. Occasionally, you want to stick to exchange rate targeting, just fixed exchange rate, because it's very complicated to be in between, right? And so you kind of have to stick either with going fully into one direction or fully in the other direction because of the commitment issues and so on. And indeed, what we find in our analysis, generically, you're not going to be in the corner. You're going to be in the corner of one policy or the other policy only under very special circumstances. But if there are some additional constraints, for example, credibility constraints, observability constraints, and so on, then you might choose a corner. Right. And so this is very interesting because in the data, we see a lot of corners, presumably. So it's very interesting to have a quantitative model that could be consistent with, you know, the fact that the model tells you that generically you don't want to be in the corner in terms of exchange rate policy. But in the data, we observe quite a few of those. Right. So what are exactly the features? This is one point I was going to make. The second point I was going to make, I think it's super interesting to go do empirical work because, for example, what our model suggests is when the policy will switch, right? Because obviously policy is endogenous to underlying frictions and shocks. And so it's not surprising that occasionally you'll see bigger UIP deviations conditional on choosing a managed peg because the choice of a managed peg is endogenous, right? And so our theory fully lays out, you know, like the incentives which will push you further to the peg and away from the peg. And oftentimes these incentives are exactly related to the underlying financial volatility, right? If you face more financial volatility, that's when you're going to abandon, you know, inflation stabilization and go for the peg because the cost of that is increasing, right? And so there are other variables that the model, for example, openness of the economy comes out and some other things which empirically, which in principle could be brought to the empirical data to kind of test it. But actually, I would disagree in the sense that going from full peg to a full float gives us a very clean exercise because once you go to a full peg, you switch off a lot of the UIP volatility. And that's what the model predicts as well. So that's why we wanted to stick with this framework. And I'll pass it on to Pierre Olivier.
Well, thank you. Like, I mean, you were juggling many balls up in the air there, and I don't know that I can do that as well as you. I think that the message, I see a very consistent message that emerges from my little paper today and Oleg and Dima's much more ambitious framework. My paper was saying, look, you want to target the CIP deviation to the extent you can measure it, and it's a clean shuttle cost of the financial intermediaries that are providing dollars. Oleg says, in my model, you want to target the UIP deviation. It turns out we want to do it with another instrument. We want to do it with foreign exchange interventions. These two messages are completely complementary, and they are going in the same direction. And they have a counter cyclical component to them as well. And so I think now that's a broad message. It can be refined. It can be micro foundations are important. They can be. There is going to be always a leap from any model, however stylized or complicated, to a policy rule or a policy implementation. If I look at the way we've built inflation targeting as a monetary policy framework, I mean, it's not the case that we've been writing models to think about what is the exact coefficient of the, on the inflation rate or on the output gap for every single country in the world. And then we went with that based on what would come out of, Bayesian estimation of a dynamic stochastic general equilibrium model. It's actually the reverse way. We had some idea about the broad principles. We implement them, that generates more data, that then it can goes into a model so that we can fine tune. But it seems to go that way. What I want to put on the table, and I think Oleg and Dima maybe to some extent are doing the same thing, is say, look, rather than be sort of intimidated by the complexity of these rules coming from these models, let's simplify it. Let's strip it down. What do we get? We get something where you want to control the extent to which those countries are facing wedges. And you want to use instruments in addition to the ones you already have. Let's go and experiment with that. We may not get it right immediately, but the general principles are going to be sound. And you build credibility along the way. Credibility, as Shebnem emphasizes, is essential in this process. You want to build the credibility in the way you construct these rules, the way you communicate about them, the way you send a signal about how they might change in the future, the way you do forward guidance with them, the way we do with inflation targeting or monetary policy, traditional monetary policy in the first place. So this is not just limited to setting an overnight interest rate. This is what I'm trying to say here. Anyway, I'll stop here.
But
I
can
just
I add
wanted
something?
to add.
No, but wait. Okay, but this is very important. I fully agree. I fully agree with what Pierre Olivier said, and we can target both. But the thing is, look at what Brazilians does and what Chileans does. I mean, the details is going to matter a lot here. Brazil, so it has a hedging market. Okay, so I see the CIP is more about the hedging instruments and deepening those markets, and the UIP is more about the ways of dealing with risk premium shock. So that's why there is a countermeasure. Brazilians did both, right? They did countercyclical capital controls, and they have a coupon cambial, onshore hedging markets. And look at their intervention. They don't do the intervention Oleg is saying. They have something actually very much in mind, like what you're saying, Oleg. They intervene in the hedging market, right? They intervene in the derivative market. They didn't do the standard sterilized intervention that Charles told us we know doesn't work that well. So that's one model. But on top of that, they also have a tax on foreigners, which they were criticized for. Chileans don't touch that, right? I mean, they don't touch the exchange rate. They don't do any capital controls, and they try to do similar interventions, but then they cannot because they don't have a market onshore that they can go and intervene derivatives. So these are very different policies. I mean, when we are saying these emerging markets, go and do an onshore hedging market, so you will completely be out of the CIP problem, but at the same time, don't do any capital control or do them too. I mean, these are very different policies, and they are going to have different effects. I mean, if you are targeting one with hedging instruments, but at the same time limiting your monetary policy credibility, then you are going to mess up the others. So what I'm saying is, depending on the instrument you use, you can solve your CIP problem, but may not solve the UIP problem, or vice versa, or you can do the reverse. So in that sense, I do believe for policy implementation, these details are going to matter a lot, and that's going to come back to how we write down the models.
I just wanted to
and
make
Chile,
one.
And by the way, Chileans, in terms of real outcomes, Chileans did better than Brazilians. Let me also say that. Okay, anyway, go ahead.
So I think it's not like we're disagreeing, right? It's just a matter of emphasis. And I actually wanted to second a lot of what Pierre Olivier said. CIP and UIP deviations are a fact of life. So they suggest that there is some risk-sharing friction. In some countries, CIP might be more important in relative terms. In some other countries, UIP. And so as Charles pointed out in his conclusion, typically in order to rationalize those things in equilibrium, you have a model with some friction, but that friction allows you for extra instruments. And while I think the general principle that emerges from both of our presentations is that you lean against those those frictions. Like if you see a UIP deviation, you try to close it, right? It pushes you in the right direction. Then it's a quantitative question, how much you want to use it. And maybe under certain circumstances, you cannot use it much, right? But the point is, once you see CIP deviations and UIP deviations, it automatically creates an incentive to use whatever tool is suitable, right, in that special case, right, and lean against that thing. And I fully agree that qualitatively, that's kind of the general message. And then, the details of these policies need to for sure be worked out subject to the constraints that these countries are facing. Oh, and the last thing is, obviously, you would like to know the shocks and everything that you're facing, but
exactly.
Oftentimes you don't observe the underlying shocks, but you do observe resulting UIP and CIP deviations to the extent you can measure them. And so they can be actionable targets then, not the specific shocks that this countries face. And so it's very interesting to actually study that, to what extent just seeing CIP and UIP deviations is a sufficient statistic for the policy rule. Yeah.
Okay.